Decent quarter for Union Bank. That's the other one. Improvement in asset quality, slight uptick in profits and net interest income. I caught up with the Managing Director and CEO, Asheesh Pandey, for the growth roadmap. Listen in to a slice of that conversation.
I would like to say one thing. If we take, the growth in the RAM sector, we have around 3% in the retail, and if we take MSME, it is around 6%, and agri around 4%. So actually, in the first half, agriculture was actually the negative. And even if we take the YOY basis, it was negative. But then retail, if we take, it is more than 21%. So I think the RAM growth is going good. Now coming to the corporate, basically, which was the concern earlier, which sometimes it has been, come into forums. So let me share with you, though it looks a bit less, but then there are two, three things in our corporate loan book. One, which we had IBPC of around 20,000 crore, which we have shared off in this quarter. Only, I think, 3,000 crore is remaining. So that is point number one. The second was around 10,000 crore, which was on the short-term loans at a very lower rate, which we have converted into long-term loans. So I think if we take this 30,000 still in the corporate book, we are in the double digit. So what I feel is a very natural growth, which we are continuing. So going forward, we are, in the same, that it will be continuing in the same range going forward.
What about margins, sir? Give us some color around that. Margins have gone up on a sequential basis. What is the margin trajectory going forward? There's already been a 25 basis point rate cut in December. What's going to be the impact of that on your numbers?
Yeah, I think in brief, I will say that there was a business reshuffle which we have done in the last quarter. The first one was the bulk deposit around 40 to 45,000 crore, which we have shed off. So I think it is coming to 5% range. Now coming to CASA is increased by 15,000 crore, and also we have increased retail term deposit rather than bulk to an extent of 9,100 crores. Put together, it comes around 4,000 crores. The third thing is that the treasury book, which was earlier 15,000 crore, which we have contracted. So I think we could maintain very good NSFAR, LCR, and other ratios. Even our LDR, if you see, it is less than 81% if it is on the domestic front. So I think keeping in view robustness, liquidity position, we have continued with the business growth. And if we take the NIM, because of actually these measures which we have taken in the last quarter, you are seeing that there is an increase of 9 bips rather, though there was a rate cut. And if you take our MCLR book is hardly 48%. It means 52% is the T-bill and RLRR based, repo based. So I think even though we conveyed that transmission as per the the repo rate cut, but then because of these measures we could sustain that. In the last press also, we were actually asked about the going forward about the name. So we only said that yes, we would like to defend it and better improve it. So I think that is the last quarter you are seeing, and going forward our aspiration is yes to defend it for sure, and then better to move it forward with the improvement.
Okay. So, sir, could you give us some kind of a guidance? What happens if there is another 25 basis point rate cut? Will margins retract or fall, or do you have enough liquidity buffers which you would wish to utilize to try and continue to expand margins? Directionally, could you give us a sense as to where margins go?
I think even because we are at the place where the GDP growth is good, the economy is behaving very well, and the low inflation is there. So even if the rate cut is there, then also actually we are aspiring to defend these margins, which NIM which we have conveyed right now, which is around 2.76.
Okay. Give us a sense on this very, very low credit cost number. How sustainable is that, and where is that coming from? Is it coming from recoveries? How confident are you of sustaining that, or what's the kind of band one can expect credit cost to hover around?
Yeah, see, if we take, the credit cost, there are 2 points. The one is how is your asset quality asset book is placed. Now if you take our the corporate book, which we say around 25 crore and more, the 94% of the book is triple B and above, and 84 out of which 84% is A and above. So it shows the color of the quality of our, the above 25 crore loan book. Now coming to the other part, which is basically on the retail. Even in the retail part, if you see, there is a huge number, almost I think it is around 76%, which is about above 750 levels. That is civil ratio. Bureau that rank is there. So I think the bureau score. So I think these two things, because basically retail and other, corporate book. And the second hand, when it comes to the recoveries and upgradation, yes, it is there. Recovery is going well, but at the same time, SMA book, if you see, it is hardly above 5 crore. It is 4,285, which we have shown as the lowest in, the past. So I believe on one hand, the asset quality on the rating side and the score side, say, bureau score side, and second is on the SMA book. I think both are well under control, and some changes we have made through technology, feet on street, and our structure till branch level. So that is why we are monitoring the asset properly, and we foresee that going forward, the same slippages ratio and the same credit cost somewhere here and there would continue in the same range.
Okay. Uh, Sir, deposit degrowth on a sequential basis, is that conscious? You spoke about how liquidity was abundant for you. Is this a conscious call?
It was a purely conscious call, and we calculated, every day, keeping in view the runoff factor on the deposit, bulk deposit, and particularly even on the bulk deposit, if it is on the financial institution side. So it was a very conscious call, around 40 to 45,000 crore, which we have actually contracted on the bulk deposit side. But at the same time, if you see, our CASA is increased by around 14,000 odd crores. Our retail term deposit, which is basically below 3 crores, amount, which is of the retailers, which has increased by 9,100 crore. So put together, if you see, around 24,500 crore, which we have increased. And treasury book, which was not yielding better, we have contracted by 15,000 crore, and we have put to the comfortable range of yield on the loan side. So I think these three things, if you see, our LDR also is a very well range, which I said earlier is less than 81% on the domestic side. And our LCR, NSFR, all we are in a robust range. So I think we still have, the bulk deposit. And certainly when there is a rate cut, it is going to be repriced. Like loan is repriced immediately, but the deposit takes there is some lag time for the deposits to take. So I think this quarter that we will be observing further that impact on the reduction in cost of funds, and probably this will help us, on the deposit and the LCR and other issues, and cost of funds reduction, and certainly defending the name which I said earlier.
At what level are you comfortable to push your LDR to, and therefore for how many quarters will there be a degrowth or a flattish kind of a?
Yeah, I think there will not be, because some of the portion which we were trying in the September also, we said it was shared up, and this quarter also. Now, bearing some, it will be mostly reshuffling the portfolio within the bulk deposit side. And certainly, the higher price one will get repriced with the lower one. That is point number one. But at the same time, we have built some new structures in our bank on CASA. And going forward, actually, we are confident that we will be in a position to sustain the growth in CASA going forward quarter to quarter. So I think the retail term deposit, number one, number two, the CASA growth. This is our prime focus area to build the total deposit portfolio. And certainly when bulk deposit is concerned, we are very cautious for going for the bulk deposits where it is getting repriced, which is a better acceptable. Number one. Number two, which is not having much impact on the LCR front. So that, we maintain robustness on the one side, and another side, LDR also we would not like to go much beyond this, because it is a very good comfortable range for a bigger bank, like Union Bank.
Hmm. So ROA now at 1.3. Uh, you've virtually exhausted some of your levers. I'm trying to understand whether ROA has any scope of creeping up from here at all.
Yeah, I think good question, and I believe still, because when we are saying what we have done is sustainable quarter to quarter. Like the first thing is on the growth on the asset side, and certainly growth on the liability side, as we discussed in the your few of the questions. I still believe there is a upward possible, and we aspire for much better ROI going forward.